As Claire said, I'm a tax product manager at Sage Accountex division. I've had some involvement in dealing with HMRC since these proposals were first introduced by them. The purpose of what I'm going to cover this afternoon is give you really the background to how this came about, to run through some of the proposals, to outline to you the position that we're up to now, and really then just to have a quick think about how it might impact your clients and small businesses, but also what effect it might have on you as accountants. This is a government-led initiative as part of really what is a pan-European programme where I think a number of EU member states have the ambition to try and reduce the administration on small businesses by some stated percentage of about 25% over the course of a few years. And this is what's led the government to start this programme here. They asked the Office of Tax Simplification to deliver a paper on this, and they came up with a number of proposals which, as you can see, between February and March time were pretty quickly superseded by some alternatives that, and some developments on what the OTS suggested by HMRC. A consultation paper went out in March this year. It was responded to by, well, individual firms had the option to do so, most of the regulatory bodies did so, and the software industry and its representative body all contributed to that consultation feedback. The feedback ended in June, and since then we've been really waiting to hear what the final outcome of that will be and what the final shape of the proposals will be. Now, we were expecting something in autumn, and we are still going to get something in autumn. It's just I think they're stretching what they mean by autumn, because it's pretty likely that the final proposals will be announced in the autumn statement, which is scheduled for the 5th of December. So I don't think we will know before that date exactly what we're faced with. So this is today's conversation is based on what we've learned from the consultative paper and what we've gleaned in the conversations we've had with them, with HMRC since that time. The key thing to note that this is primarily based on providing a benefit to small businesses. It's not aimed specifically at accountants, it's aimed at unrepresented small businesses, but we've got a pretty good suspicion that it is going to impact you as accountants as well. So the first thing to say that it looks nice and simple. It is a voluntary system. Nobody has to sign up to this. No small business has to sign up to this. And you know, on a simplified cash basis, money in, money out, no adjustments. That sounds great. Unfortunately, that's a little bit too simplified. There is going to be a bit more detail around it than that. If you sign up to the simplified cash basis, there is a mandatory element to it, which is that you will take on what they've described as simplified expenses. Now, there are a number of expense categories that we'll look at later, where instead of just obtaining a deduction for the cash amount you pay, they're going to ignore the cash amount completely and give you, or give the small businesses a deduction at a standard rate, and we'll come to those later. It's introduced from the 6th of April 2013. I think, so the first tax returns it will hit will be the 2014 tax returns. And obviously we don't know what those tax returns will look like. There will need to be some changes. We're not quite sure what those will be, and we probably won't find out till around about this time, perhaps September, October 2013. So we can't tell you what they look like. But from a record-keeping point of view, this is going to be effective from the 6th of April 2013, and it's on that basis that I think your clients and potential clients, small unrepresented businesses are going to need to be made aware of this. It starts on the 6th of April 2013. It is a tax year based system, so everybody will be assessed from the 6th of April to the 5th of April in headline, although as we'll see there is the potential for some shift in that position from HMRC, but this was this is the only stated position that we've had from them so far. So what constitutes a small business to be eligible to take part in this cash accounting basis scheme? Well, you have to be unincorporated, a sole trader or a partnership. If you are a partnership, you can't have no mixed partnerships, no corporate entities can be involved in that. We've got some income limits here that will appear a little bit confusing, but to start with, you have to have an income level of £77,000 or less. That is designed to hook in with the VAT registration limits, although, as you'll see later on, there are also some anomalies there. So on the basis that your business has receipts of less than 77,000 now, you will be eligible to join, and you will be eligible to stay in the cash basis until your receipts reach £150,000. Now, in HMRC's words, they are giving businesses the opportunity to grow until the natural complexity of their business means that the accruals basis would be more appropriate for them. So they've given themselves leeway to let businesses grow, to not put them into something that they'll immediately have to be switched out of. For anybody that controls more than one business, for any of those businesses to be part of the simplified accounting, all of those businesses not only have to be eligible to be part of it, but actually have to be part of it. You can't have some businesses dealt with on an accruals basis and others dealt with on the cash basis. There is, as HMRC tend to put into these things, at least one exception, which is that if you are a partner in a large partnership where you don't exercise any amount of control, you're a very small partner, then that business can be discarded, because obviously that wouldn't be eligible for the cash basis, but you will still be able to run the rest of your businesses through that. And lastly, it might be quite a small piece, it might not. It's available to foreign residents, anyone with a business in the UK. HMRC have assumed that this is going to be appropriate for most small businesses. They think they've designed it so that it will be the weapon of choice, if you like, the set of accounts of choice for a small business. And they're assuming that for eligible businesses it will probably be about an 80-20 split of people opting for the cash basis as against staying on an accruals basis. What is not an eligible business? Well, if you currently have a business and your turnover, your VAT inclusive turnover is greater than 77,000. So in the example here, your receipts are greater than 100,000. You will not be eligible, even though other businesses starting up this year who might, or starting up in next year, who might have a turnover by the end of that year of £100,000 will be eligible and will be able to stay in the cash accounting system until their receipts reach the 150,000. Specifically excluded are any entities that have any suggestion, any whiff of a company about them. So if they're subject to corporation tax, LLPs, mixed partnerships, as we said. Because they want to try and unite as many things as possible, they're looking to try and hook up not only VAT, but also some of the tax credit legislation in with this, and along with the DWP. If you're not in the cash accounting system, you're not working on as simplified a basis as you can there, then again, you're not going to be eligible. So as well as, if you are eligible on receipts basis, as well as changing your accounting year, and as well as changing to the cash basis and adopting simplified expenses, you will have to adopt VAT cash accounting. It's not available where there are already concessions for revenue spreading, so things like farmers, authors, not available for any of the financial services type operations, although we made representations, as did a number of others, as part of the consultation process around property businesses, suggesting that if you're a small property business, you're probably not really that dissimilar to a small business generally, and HMRC as part of that consultation paper suggested that they might look at property businesses later. We don't know why it's not now, but watch this space and we'll hear more from HMRC then. So, it's important to state that the cash basis is a cash basis for income tax purposes, simpler income tax for the simplest small businesses. This is not a set of accounts. You can only use this for your tax return. So there are no accounting principles, it's not UK GAAP, there's no financial information going to be presented as part of this, we understand. Although we don't know what the tax return is going to look like in terms of the boxes, there will be no P&L, no assets associated with this, and it is designed for people, for businesses that don't have a requirement for other users of financial statements to look at the accounts that are being produced. One of the big simplifications is obviously there's no capital allowances. We know that that's quite tricky for a lot of small businesses, and with the dual aims here of reducing the amount of administration placed on businesses and also making the income tax position far clearer and far more certain for unrepresented small businesses. The emphasis on cash basis for those purposes, for HMRC purposes, has been made there. But anyone that needs accounts for funding, for lenders, will still need to prepare accruals-based accounts. So, cash in, cash out, nearly. We've already seen that there are a few differences. I mentioned before, it's a tax year basis, 6th April to 5th April. Already we know that's not strictly true. In response to the consultation document, HMRC have taken the point forwarded by accountancy bodies as well as us and other software companies, that if you're going to try and align with the VAT legislation, then perhaps allowing the 31st of March, so it at least tries to align for reporting purposes with your VAT returns might be a good idea. And they appear to have accepted this. We haven't had any written confirmation, but in conference calls with a number of suppliers, they have suggested that would be the case. We last spoke to them in early October when they organised another follow-up call to find out that they're, as I mentioned earlier, starting to work with DWP on hooking this up more with the tax credits legislation that's coming on. The view then was that, well, tax credits are going to renew at not one specific date in the month. It'll be potentially throughout April. So actually, what they've now suggested, although we have no idea whether this is going to come to fruition, is that any accounting period end between the 31st of March and the 30th of April will be acceptable. So it could be that one year you'll have up to a 13-month period, the next year it'll be an 11-month period. It's getting a little bit more complex and a little bit less simple. Sorry about that. For small businesses to be able to run this on their own. So, what does cash in mean? Well, it is VAT inclusive. So if you are VAT registered, your receipts will include the VAT you pay. If there are goods transferred, the value of those goods that you receive will need to be included. There will need to be an adjustment for that. If there's a sale of assets, really the wasting assets, on which you'll see that there are some deductions available, they will need to be recorded. The sale of assets will need to be recorded as part of your income, where you've been able to get a deduction in the year that you purchased those assets. What's not included, the funding transactions, so how you get your money, any loans you have, any assets that you won't get any deduction for that aren't directly involved in the running of the trade. And it says tax refunds, but that's income tax, capital gains tax refunds. If you have a VAT refund, because you will get the payment of VAT as an eligible expense, any VAT refund is going to be a taxable receipt that you will need to account for under this scheme. So, on a cash out basis, anything that is wholly and exclusively, so no difference to normal income from trade or profession here, certain capital costs, you will get those full deduction in the year that you buy wasting assets. So we mentioned earlier there are no capital allowances. If you buy plant and machinery, you'll get 100% deduction for that plant and machinery in the year that you acquire it. Not cars and motorcycles. Of the fixed expenses that they have envisaged for this, cars and motorcycles are the one that is non-negotiable, that you have to sign up for their fixed expenses scheme, and they are treating cars and motorcycles as a specific case throughout the whole cash accounting system. For those you will get fixed mileage rates, but we'll come on to that later. You will be allowed deductions for HP interest, although if you look further down, there is no deduction on the face of it for loan interest or borrowing costs. The rationale behind that, but letting you have the HP interest, is obviously the HP interest is very closely linked to the specific asset you're acquiring, whereas giving a deduction for loan interest for non-specific elements that could be business related, could be personal related, they want to try and maintain that distinction. So there will be no interest for allowable on funding costs generally. Adjustments for private use of assets seems fair enough, and obviously no tax and NIC payments, although as I mentioned you will get the VAT payments as part of your tax expenses. Having said that they're not going to allow interest, they've then suggested, although we don't have any firm knowledge whether this will come to pass or not, that there may be a de minimis limit of between £200 and £500, which is allowed almost on a no questions asked basis, but we'll have to wait for the statement to find that out for sure. So, from the set of accruals accounts, you're going to need to make the adjustments to strip out all of those entertaining, depreciation costs, to strip out all the adjustments for the items that are not going to be allowable, and your profit figure, your net cash figure, as adjusted by some of these simplified expenses and adjustments that must otherwise be put in there, is the taxable income. There are no capital allowances. There is nothing further that you need to do. When you have your cash figure, that is the figure that will go in the tax return. Losses, or negative results, as they're calling them, have to be carried forward. They're saying there is no sideways relief against other income, but actually it looks a little bit more involved than that. It looks as if they're almost ring fencing completely losses from this cash accounting basis. We don't know, but we don't think from the conversations that we've had with them that you will be allowed to offset other losses against cash accounting profits. We don't think that if you have multiple businesses in the cash accounting scheme, some of which are profit making, some of which are loss making, that you can offset between those businesses, although we don't know. We couldn't get an answer, so we don't yet know whether you'll be allowed, if you set up a business, whether you'll be allowed to set off a loss in year one against your earned income of that same year. And we suspect not, on the basis that they appear to be trying to ring-fence these things. But none of these things we can say with any certainty really until the autumn statement. There are some special cases that exist at the moment, special cash accounting systems that exist for barristers. Those are going to be withdrawn. We'll see later that where there are some other informal agreements that already exist, those will be withdrawn too. One topic that did cause a little bit of debate, both internally at Sage and also as part of the consultation process, seemed to be letting people switch in and out. How often could you do it? Would people want to do it? Should there be any restriction on it? HMRC have decided that they're not going to restrict the number of times, as you can with an accounting date change, for example. They're not going to put any restriction. So potentially you can flip-flop in and out of the cash accounting basis back onto the accruals basis on a year-by-year basis, which could cause headaches for all involved. It's pretty unlikely to happen, but there are potential implications that we need to look at. There are a whole load of adjustments that will need to be made, obviously. If you're moving between those bases, adjustments happen in the year following the move. So if you adopt the cash accounting process from an accruals basis now, the adjustments will be made in year one of the cash accounting scheme, and when you cease to be part of that, the adjustments when you revert back to accruals. And obviously it's going to be the timing of receipts and payments, and if you've had VAT payments or repayments after exiting the cash accounting scheme, those will need to be discounted, and some things about assets that you've had. If you have if you have a written down value against assets when you join the cash accounting element, you'll get credit for the remainder of that written down value in your first year in cash accounting. So adjustments that I think everybody would probably think are reasonable and understandable, but they're still going to be a little bit finicky to work through. So we mentioned before that if you choose to adopt the cash basis for accounting for income tax purposes, you have to adopt simplified expenses. And the mandatory elements of this, as originally proposed in the consultation document, were the top three. So standard mileage. We've seen before that there are no deductions for in the year of purchase of cars or motorbikes. You will be claiming for the business mileage that you incur with those vehicles, and you'll get the standard expense back, which, in line with Schedule E, 45 pence for first 10,000 miles, and then it goes to 25 pence for cars per mile and constant 24 pence per mile for motorbikes. But if you adopt that, there is no other deduction for any associated vehicle expenses. So no MOT, no licence, road tax, not the purchase itself, not the fuel, not the insurance. No expenses associated with those vehicles will be allowed. The second element, the flat rate expenses for business use of home. So that's now going to be allowed on a month-by-month basis, assuming that you meet certain de minimis limits for carrying out core business activities from your home as part of your business. That doesn't include being on call, it doesn't include warehousing or holding stock there. It includes actually making things or generating business. So marketing, sales, promotional activities would count. You have to achieve at least 25 business hours on these core activities per month to get any deduction. There are two alternative proposals that were put forward. One was a sliding scale, which was if you did between 25 and 50 hours, you'll get £8 per month for use of your home. Between 51 and 100, it goes up to 16, and over 100 per month, it goes up to 24. So some months you could claim, some months you might not be eligible. The alternative is a flat rate 16 across whatever the number of hours you put in, as long as you achieve that de minimis 25. The third one is a flat rate adjustment for personal use of business premises. So anything on which business rates is payable is broadly the category that we would understand that to be. And that depends on the number of people using those business premises as for personal use. One person, £350 per month. Two people, 500. Three or more, 650. So a reasonable amount 650. A reasonable amount to be paying. So we said those three were mandatory. Again, with no written evidence, only the conversation that we had with them where HMRC said they were leaning towards perhaps making those second and third categories optional. As we mentioned earlier, for cars, motorbikes, absolutely no chance of changing that. That's set in stone, that will be fixed rate deductions. But the other two could fall into the optional category. Standard mileage for vans, you can select if you want to do that. As we said then, you would be charged on the same mileage rate as you would for vehicles, and then have the same adjustments if you're moving into the cash basis. However, once you have gone into the cash basis, even if you revert to accruals basis in a later year, you won't then be able to reverse out of the standard mileage for any class of assets, so vans, and certainly not for cars or motorbikes. You will have to live with those the business mileage only deductions for the life of that particular asset. The others are relatively peripheral. They haven't really given us very much detail on those. If you have minimal use of phone, internet, they'll let you off magnanimously. Subsistence costs we don't know very much about, because they're going to have a good look at that again, review it on a wholesale basis, and we haven't really heard any detail around that at all. And the idea around stationery, you could opt to price out what it costs to send out a letter, for example, and charge that out at £1 to cover printing, postage, envelopes. As long as you come up with something that's reasonable, I think they will accept it, but that leaves the margin for a discussion on what is reasonable. So, where are we up to? Well, the consultation period's ended, as I mentioned. We've had conversations with them since then which have suggested a change in their position, although we've got no guarantee that change will be carried through to the final documentation that comes out, which we're expecting, as we mentioned, in December. They've hosted that session with us in October. Not only are HMRC and DWP continuing to work together, we only found out that was really happening at that October conversation, that they were trying to hook in the tax credit regime in some way, shape or form with the cash basis. So there may be more to come on that, but all the detail we've included so far. They're also apparently still talking with the accountancy bodies. We don't know what the substance of that is either, but it looks as if there are still further changes to come. So the next steps, whether or not we get the publication of the results of the consultation before the autumn statement, or whether they all come out at the same time, we'll wait and see. We had thought the guidance would come out earlier, because obviously as software suppliers, if we're going to start to look to address this, particularly on the record keeping side, we need to be, well, time is short, so we need to know what's going on, and we haven't got that clarity yet. And then the draft legislation will be coming, I mean, if applicable, we're pretty certain that it's going to be coming into play from April next year. So that legislation will be in the Finance Act next year, but it will apply retrospectively, because people, if they're wanting to take part in this, will have had to have been keeping records since April. So the purpose of this, again, the purpose of HMRC introducing this was twofold, as we said at the top: to reduce the administrative burden on the smallest businesses, unrepresented businesses, to make this a simpler process and a simpler administrative process for them, but also to increase certainty around their tax position, to enable them to be able to do some of this work themselves potentially, but through not having to understand some of the things on here around complicated records, around the stock, around capital allowances, to be able to manage their own tax affairs. The quid pro quo is that, particularly if those three expense categories are maintained as mandatory, they will have to start keeping more detailed records of mileage, of not only the level that they're claiming for business use of home on a monthly basis, but also some kind of proof around that, which I don't know how easy that will be to do, and probably least contentious in terms of record keeping will be use of business premises for private use. So the new simpler scheme, as I said, they think it should be applicable to most businesses. It will be entirely voluntary. There was a debate whether they should force all new businesses to adopt the cash accounting scheme. They think they've got the balance right, that the ease of use and the straightforward understanding for unrepresented businesses will mean that those 80-20 split of businesses that qualify will probably want to take this up. So, record all cash receipts, record all cash payments, record those expenses, make those simple adjustments for the fixed rate expenses. The only time you need to do anything, if it's not a claim, there will be, we're told, a tick box on the tax return that you select, and that will be enough to notify HMRC that you're going to be using the cash basis for that tax year. The added complexity, which I don't think should be underestimated, is the impact that for existing businesses to change and move on to that cash basis, and the adjustments that will be involved. That, I think, is where the complexity isn't eliminated necessarily, and where there's a good opportunity for accountants to step in and start to try and give some guidance and help on this. So, impact on accountants. There's not really very much on the slide, and probably in reverse order. I mean, for your existing clients, certainly you need to perhaps review and discuss what you're going to do with them, but before that is the position that you're going to take. Is this going to be worth your while? Will you be able to recover the fees on this? Will you be affected by this? We did a survey where, as part of the consultation document, we asked our customers, and probably about 70% of them thought that although this is directed at small businesses, it is going to impact them as a business to the extent that they think they're going to have to do comparisons of the cash and accruals basis, and probably most of them thought that they would probably have to do that on a yearly basis. If they didn't do that, then would it open them up to negligence claims? Would they be seen to be doing the best thing for their clients? I don't know the answer. This was the feeling that we had from our customers who replied. We'll have to wait and see. It is going to depend on what the final shape of the legislation that comes in is. Do you adopt a position that says, well, actually, in the round, we think that most of our customers are going to need accruals accounts for other purposes beyond HMRC, and you price the service that it's not economic for clients to do it? Do you price the service to entice clients to do it so that you can go and gain all of those new customers that will try this on their own and then potentially realise that there are a number of pitfalls to it? In terms of what we will be doing to support you and to support small businesses, the tax position is pretty clear. As part of the normal compliance that we would do, our 2014 software will include the tax return that includes the capabilities to deal with the cash basis. Should clients decide that they want to adopt that. From a record-keeping application, we're far less certain. We don't know what the adoption rates are going to be for this. We think that people will come, but we don't know how many will come. We don't know what the shape of the record-keeping needs to be. And from the input we've had so far, customers, accountants, where they're going to get involved with this, seem to think that they're going to do it themselves or in conjunction with their clients on a spreadsheet basis almost. There's a nice simple record keeping that maintains the bookkeeping records, doesn't confuse what's happening there for the preparation of accruals-based accounts. So although we are looking at what we're going to do, it's far from certain yet that we have that solution, and we know that we need to get that in place for the end of March next year. So the summary really is that it's a work in progress. We know what was written, we know what we've been told since informally. We don't know how that's going to transpire because there are still ongoing discussions that we're not necessarily party to, but it is pretty likely that in a drive to be able to say, look how great we are at having simplified business for these small firms, that something will come into play which will require record-keeping changes to be made by your clients, probably more so than you, by April 2013. You may not be affected beforehand, but obviously the tax returns will be impacted come 2014. So watch the announcement on the 5th of December. It may come sooner. They haven't said that they'll wait till that long, but given the short time period between now and then, I suspect they will grandstand something at the autumn statement. And obviously think what it's going to do for your clients, think what it's going to do for you and your business process, think what it's going to do for you and how you want to approach dealing with your clients and the prospective opportunity that this delivers for you to go and acquire new clients. I'm sorry I can't give you definitive answers, but this is about as sure as we get at the moment. And welcome to our world in software developers' world in accommodating HMRC changes. That's it. Thank you very much. If there are any questions, I will happily address them.